Look, there's a number of different stablecoins that have different kind of twists to them. So if you look at Tether, for example, Tether has really said, what we want to do is we want to take the US dollar, which is one of the best product market fit products ever created in human history, and we want to bring it to people in the emerging world. They have something like over 400 million users. I think they're gaining 30 million users per quarter. Just crazy numbers. $13 billion in profit, over $85 million in profit per employee. Amazing business. Circle has said, well, let's go and actually be the U.S. regulated financial institution and try to go get distribution through exchanges like Coinbase and others. So both of them are attacking a market from two different ends, and I think that both will end up having a business.
One stablecoin is printing more profit than Goldman Sachs. The other is burning millions, building regulatory trust. In this video, we're breaking down the financials behind Circle and Tether and asking the real question, does Circle actually deserve its multi-billion-dollar valuation? Circle generated $1.68 billion in revenue in 2024, largely from interest income on USDC reserves. But after subtracting costs and payouts, its net income was just $155 million, giving it a thin 9% profit margin, the single biggest line item dragging down profits. Revenue sharing. Circle paid over $1 billion to ecosystem partners, and $908 million of that went to Coinbase. That means Coinbase made more from USDC than Circle itself did in 2024. Why? Circle needed help scaling USDC in a market dominated by Tether, without early exchange integrations or liquidity dominance. Circle had to partner with major players like Coinbase to accelerate adoption, and that came at a high cost. Circle also employs around 900 people and spent $263 million on employee compensation, an average of $290,000 per employee. That's high, but typical for a tech and compliance-heavy fintech firm. Still, from a traditional valuation lens, it raises flags about operational efficiency and cost-to-profit leverage. Investors will be asking, is this high burn rate a short-term strategy for long-term positioning, or an ongoing structural drag on profitability? Tether, on the other hand, made around $6.2 billion in profit in 2023 and $4.5 billion in Q1 of 2024 alone. It's doing Goldman Sachs level profits with 0.2% of the staff. Goldman made about $7.9 billion in profit in 2023 with 49,000 employees. That's about $160,000 per employee. Tether, around $60 to $85 million per employee. That makes Tether arguably the most profitable company per employee in the world. It earns its revenue mostly by investing over $80 billion in U.S. treasuries, and unlike Circle, it doesn't split that yield with anyone. No major compliance costs, no marketing spend, no bloated payroll. It's lean, efficient, and ridiculously profitable. Tether and Circle operate at completely different levels of efficiency. Circle generates about $1.9 million in revenue per employee and about $173,000 in profit per employee. Tether generates roughly $70 million in profit per employee. Circle reinvests profits into compliance and partnerships to stay regulation ready. Tether converts profits directly into margin. It's two radically different models, one built for institutional trust, the other optimized for pure cash flow. So why does Circle deserve a $5 billion IPO? Because it's playing the long game with the regulatory moat. Circle is US-based, regularly audited, and operates under money transmitter licenses. This gives it credibility and access that Tether can't match. That's why firms like BlackRock, Visa, and MasterCard are choosing to work with Circle. These partnerships aren't just for show. They create real network effects and distribution channels. BlackRock even signed a 4-year agreement to manage up to 90% of USDC reserves and agreed not to launch a competing stablecoin. That's a massive vote of confidence and a strategic barrier for future competitors. By absorbing high short-term costs like compliance, audits, and ecosystem payouts, Circle is betting that as stablecoin regulation continues to roll out globally, it will be the most prepared. Circle's licensed, transparent model positions it ahead of the curve, and that positioning could ultimately justify a premium valuation. That said, Tether deserves credit for building a model that is not just profitable, but remarkably efficient. With minimal staff and near zero burn rate, it has scaled without needing outside capital or partner subsidies. While Circle is investing heavily for future dominance, Tether has proven that a lean, self-funded operation can dominate today's market. It's not just a question of compliance, it's a bet on which strategy wins over time. Tether continues to lead in profitability, with Q1 2024 profits topping $4.5 billion and virtually no burn rate. It's proof that in today's market, lean operations can dominate. Circle, meanwhile, is securing long-term partnerships, like its exclusive reserve management deal with BlackRock, and positioning itself for regulatory-first integration into global finance. Both are winning in different ways, one through sheer efficiency, the other through strategic infrastructure and trust. So what do you value more, profits today or trust tomorrow? Let us know in the comments.